The stock market is a place where people buy and sell shares of publicly traded companies. Let's break down this concept with a simple explanation and an example. Number one, shares in stocks. Imagine you start a company and divide it into small pieces. Each piece is called a share or a stock. When you own a share, you own a small part of the company. Number two, publicly traded companies. Some companies decide to sell their shares to the public to raise money for their business. These are called publicly traded companies. Alright. Number three, stock market. It's a market, those. The stock market is like a marketplace where these shares are bought and sold. It's a platform that connects buyers, that's investors who wants to buy invest money in the stock, and sellers, people who want to sell their shares. Buyers and sellers could be people like us. We buy stocks, we want to sell it, so we are investors, we have bought it, and then we want to sell them to somebody else. They are called sellers. So buyers and sellers, people or institutions looking to sell shares. Okay, let's have some examples. All right. Let's say company ABC is publicly traded and its shares are listed on the stock market. You decide to buy 10 shares of company ABC at $50 per share, spending at least $500. Now you are a shareholder of company ABC. If the company ABC does well and its value increases, the price of each share may go up. If it goes to $60 per share and you decide to sell as a seller, now you are a seller. First you are an investor and now you are a seller. You can make a profit by selling your shares for $600. That's 10 shares of $60 each. On the other hand, if the company faces challenges and the share price drops to $40, so you might sell at a loss because you don't want to lose more money. You already lost about $10 over the 10 shares you bought for $50. So you might sell at a loss, getting only $400 for your 10 shares. Alright, I hope you understand. I'm trying to understand as well, those. Key points here, though. So investing in the stock market involves, this is very important, I think, before you even think about it. Investing in the stock market involves risks, as stock prices can go up or down. Investors can make money through capital appreciation, that is selling at a higher price, or dividends, that's called periodic payments made by some companies to shareholders. These are much safer, I guess, the stock, because no matter which way the stock market goes, which way the stock markets go up or down, the company still pays dividends for the shares in their companies. These are very, very reputed company, big companies, those, right? All right. Now, basically, it's very, very important to research and understand the companies you want to invest in and have a long-term strategy. All right. Remember, the stock market is a way for companies to raise capital, and for investors, it's a place to potentially grow wealth by participating in the success of those companies. It's crucial to approach stock market investments with a well thought out plan and a long-term perspective. Those so very, very short talk on this, because people were asking to talk a little basic on stock market. So as we keep getting more and more into it, and people who are in stock market business, if they would like to participate to explain to our viewers more about this, we will try to look for people who can really give us a short talk on